Anytime that you do an M&A transaction, you have to have a willing seller and a willing buyer, and they both have to feel like they've got a good deal. And if either one of those parties are unrealistic of the valuation they put on the organization, then you'll never sell an organization, nor will you ever buy one. So what I think that we provide here at DD&F is there's a three-prong approach to looking at a bank for determining what it can sell for, what you should buy it for, and also what the value of it is from a certified valuation analyst standpoint. And there's three metrics that you look at for determining those values. You look at prior transactions, which, if you get a comparable person or organization, then you can base your valuation on that. The problem with that valuation, it is a lagging indicator. In other words, it is an indication of what the market was 6 to 9 or almost a year prior. So many times a seller will look at, well, his friend sold his bank for 2 times book, therefore I should get that multiple. Well, the problem is that's a lagging indicator and may not be a realistic valuation. It might have been in that economic environment. It may not be in today's economic environment. The second valuation that you can look at for determining what something should buy or sell for is what current stock market prices for publicly traded organizations are going for. What the multiple of earnings, last 12 months earnings their stock's trading for, or the multiple of tangible book to or their whole bank, their whole equity is trading for. The problem for that type of valuation is that your organization isn't like the Bank of America's or the Citibanks of the world. You may have a much smaller organization that really doesn't have comparable publicly trading that have the liquidity in the market as those type of transactions reflect. The third type of valuation is just doing a discounted cash flow analysis or a capitalization rate of what you project your earnings to be, and based upon appropriate discount matrix risk factors of the market, your industry, and your particular organization, what is the current value of those future earning streams are. And so what you do is, as an analyst, is you look at those three metrics and you determine which is the most appropriate, or what is the correct weighting of those different types of valuations. And I think that's where DD&F, because we have such long history of valuing banks, 35 years experience, but also have seen multiple sides of those transactions, whether it was representing buyers, representing sellers, or being a certified analyst valuing a bank. There's always those type of what we call professional calls that you have to make to determine what is the correct valuation and what is the correct weighting of the different metrics for determining what your value is. And I think we provide that type of knowledge and expertise in order to give you a good value for what your bank is and setting the expectations of what you can sell your bank for, or running the quantitative side of purchasing an acquisition to make sure that it is a good transaction for you and your stockholders, because ultimately, as a buyer, you're representing the stockholders, and you always want to better the organization